Hi, this is Richard Kirby over at, I'm the managing partner of Kirby, a new real estate brokerage here in Mansfield, Texas. Today I have one of my loan partners. His name is Eric Wommack over at Service First Mortgage. We are super excited to be in business and in partnership with Eric Wommack. He has a lot of experience in the mortgage industry. So I'm going to just jump right in. Eric, tell us a little bit, man, about how long have you been in the mortgage industry?
Been doing loans for 20, going on 24 years.
24 years, okay. And then over with Service First, how long have you guys been partnered with Service First Mortgage?
Just crossed over 10 years.
Crossed over 10 years with mortgage. What started you guys in the mortgage business? And tell us maybe a little bit about your team.
Well, what started me in the mortgage business is it was in the real estate industry first back in the 90s, and went off and got my degree in mortgage finance. And when I came back, I didn't go into the real estate. I went into the mortgage side. So back in 98,
Okay.
graduated into the mortgage with a degree in mortgage finance, and started jump straight into doing loans back in 1998, and kind of took off. Most of my team has been with me since 2003, so
That's
about 18,
really
19
strong.
years.
So most of your team's been with you since 2003, and I think the great thing is that you and your lovely wife work together too. And how long has she been working with you?
Since 2001. She's been running the ship since 2001.
That's a really really strong foundation. Tell us a little bit about maybe some of the challenges that maybe buyers are facing, or that you're seeing buyers are facing right now with the way the market is.
Probably the number one challenge is number one, just the lack of inventory. We're having record number of buyers move to Texas from California, from New York, all over the place. Texas is a great place to live and work,
Absolutely.
but we have so many people moving here that there's not enough inventory for the buyers that are out there. And then we're adding more buyers on top of it at a record pace. More companies are moving to Texas. There's just not enough out there. And when a first-time home buyer, or a buyer that does not have the advantage of having just sold a home in California and made enough to pay cash for a house, so our buyers that are coming in with financing, they're looked at as, I don't know, not as strong, as favorable as someone can walk in and pay cash for a home.
Absolutely.
And then, some of these cash buyers are paying, if a home's listed for 300, and they're having to pay 350 to be able to compete with the other cash buyers. So that's probably the biggest hurdle, is just inventory and the amount of buyers that are out there. And if we have different types of financing, FHA versus conventional financing, sometimes the buyer needs to go on under FHA, but it's not looked as favorable from a seller standpoint.
Yep.
Because of the increase in the cost of housing.
Gotcha. So, what are some things, Eric, Ben, that you've been able to do? I know you guys are problem solvers over there with the Womack Group. So, what are some things, I know before you kind of talked about maybe taking a buyer all the way through so that you can do a quicker close or things like that? So, what are some creative things that you do to help buyers get in and beat those challenges?
That is called our certified buyer program.
Okay.
So there's different levels of being qualified. There's a lot of loan officers. There's some companies out there right now that are pre-qualifying based off of, not even, it's a soft inquiry on a credit report. They're not pulling a full-blown credit report. That's the weakest form of a qualification. The second is to be a pre-qualified buyer. You're doing a hard hit. You're looking at income. You're looking at assets. But then whenever you issue a letter, there's either a letter that we've either verified your information, or a letter that we have not verified your information. Obviously, when we verified your information, that is the stronger of the two,
Okay.
but that is a pre-qualified buyer. A pre-approved buyer has been through the underwriting process. We rolled out our certified buyer program. We're going to take that borrower and put them all the way through underwriting. We're going to do everything except you don't have a property yet. We're going to have an underwriter sign off on your income. We're going to have an underwriter sign off on your assets. So we know that when you go out and buy a home, you have the income. It's already been verified and underwritten. We've already verified your down payment, your assets. We've already seen it. All we need is that contract. You can go write a contract on a house, and literally in 2 weeks later or less, in a time for us to get an appraisal, you can go close on a home. That approval letter is the strongest form of an approval letter when you get it in front of a listing agent, a seller, because they know that you've gone all the way through the steps. You've gone all the way through the steps of underwriting. It's also, it makes it to where when you you as an agent write an offer, you're not writing it with any financing contingencies in there because the financing in there is already done. So sometimes you'll have 21 days of financing contingencies. Well, if you can take that to zero, it's a benefit for you and your buyer because they've already been through the process of underwriting. So it's the strongest of the strong.
No, that's a really, really, really good thing. One of the questions that we get a lot, and I know one of my agents was in here earlier this morning, and he talked about dealing with a new first-time home buyer. They always have that concern about, how much money am I going to have to bring to the table? And the number, I don't know where this number came from, but everybody always says 20%. Is that true, Eric, or what are some things that they can do, and how much money do they really need to bring to the table?
There's a lot of misconception. We have a lot of buyers that come in and say, "Oh, I don't have 20% down. I need 20% down." No,
You know where that number came from? Why does everybody think that?
No, okay, back in probably the 80s, the financing used to be 20% down. This was a long time ago, and there's some agents that just didn't know, but it was way before I was in the business. But back then things were different. It was just the hurdles were harder. I'm not sure exactly where it came from, but you can go on an FHA of 3.5% down payment, and then you have your closing costs on top of that, which is probably in 3 to 4%. So your total all in is probably around 7 to 7.5%. All in your down payment plus closing costs and prepaid expenses. But then on a conventional, you can do it with a 3% down financing. So you can go on a conventional or FHA. We have to figure out which one you qualify for. Sometimes not all buyers can go conventional, not all can go FHA. So we just have to, throughout the pre-qualification process, we're going to see what you qualify for, what is best for the customer.
Okay. So answer me that, because I know that's another question that comes up. What is the difference, or what is the advantages to FHA versus conventional? Why would somebody want a FHA and why would somebody want a conventional loan?
Well, the main advantage of going conventional is that once you get to 20%, if a borrower comes in and has 20% down, there is no PMI, private mortgage insurance.
Okay.
On an FHA loan, you have MI, mortgage insurance. They're one and the same. It's just that mortgage insurance is government insurance. PMI is private mortgage insurance. It's private entities. But on both loan scenarios, you have mortgage insurance. A lot of people on an FHA loan, the disadvantage is that you have mortgage insurance for the life of the loan. Mm-hmm. On a conventional loan, if you come in and put 5% down, and then, let's say within the next, in the future, you put the extra 15% down, so you have a 20% down. At some point, the mortgage insurance can go away, whereas on an FHA loan, you always have mortgage insurance.
So could that be substantial savings for the client?
It can be, but whenever we're talking about pre-qualifying a buyer, we want to always make sure and look down the future. So the average time the average homeowner lives in a property is 4 to 5 years.
Okay.
So if you're going to come in and you're going to put 3.5 to 5% down on an FHA or conventional loan, you're going to have mortgage insurance on either program. So we kind of remove that out of the equation, because you're going to have mortgage insurance on either one. Some people get hooked up on I'm going to have PMI or mortgage insurance for the life of a loan on an FHA loan, but you're not going to live in the home for the life of your loan.
Right.
But if you're going to live in there for 20 years, it might be different. So an FHA is typically geared toward more of the first home buyer. A conventional loan is more, you've come in. Now you can do as many FHA loans as you want. There's no minimum or maximum. You can just have one at a time. And there's some circumstances when you can have multiple, but the majority of the first home buyers go on an FHA financing. You sell that home, you come up with a 10, 15, 20% down payment. And then in the future, it would be better to go conventional.
Gotcha. Let me ask you, Eric, now, as far as the down payment and stuff are concerned, I've heard of grant programs, and, we've done a couple before. Are there grant programs still out, and can they still be effective in the type market that we're in right now?
yes, there are plenty of grant programs out there. There's some that you have to pay back. There's some that you don't.
Okay.
We like the ones that you don't have to pay back. The majority of them, you have to be in the home for at least 3 years.
Okay.
You can utilize those. A lot of people don't realize this. You can utilize them on an FHA or a conventional financing. They can be used for your down payment. They can be used for closing costs. A lot of times where we're seeing as a big benefit is if you're coming in to buy a home right now and you have your down payment, and with the market that we're in right now, most sellers are not wanting to pay for anything. They're not wanting to pay for your closing costs. They're not wanting to pay for your title policy.
Nothing.
You can utilize this grant program. It just gives you money to help go towards your costs. So, and here's kind of how it works. And this is kind of today's rates, with a 4% interest rate on this grant program, you'll get 3% in assistance. So on a $100,000 home, you would get $3,000 in assistance. At a 4.5 rate, you could get 4%, or you can go all the way up to, I think it's 4.625, 4.75, and you can get up to 5% in assistance.
Okay.
So if you're going to go in on a house, and if you just need a little bit of help, and that 3% on a conventional loan might give you the funds you need to be able to pay the title policy, to be able to pay all your closing costs. That way, if you're going up against a buyer who has more funds available, they don't need any assistance from the seller. At least it makes you more competitive for that buyer.
Leveling the playing field, kind of. So now that's an excellent thing. So, Eric, before we let you go, I mean, you've done an amazing job of answering those questions. Tell us a little bit, is there anything else that you may want to share with our audience? It could be something about refi or cash out refi, because I've been getting a lot of questions about that, or that could be another show, but maybe anything else that you may want to share with our audience about, the Wommack Group and how you can help them get into their new program.
We're seeing, and this is a number I just saw, I know recently, over the last 2 years, we've seen a lot of borrowers wanting to refinance their homes. We've seen a 70% drop in refinances because interest rates have climbed up. That's just your standard rate and term. You're just taking your higher rate and lowering it to a lower rate. That's just a standard rate and term refinance. But what we're seeing a lot more of now is home equities or cash outs. What we have experienced over the last 2, 3, 12 months even, we've seen housing values go up 50%. I mean, it's increased a lot. So in the state of Texas, you can go in and borrow up to 80% of whatever your home is worth. So we're seeing borrowers go in, borrow money either to, let's say, if you can't go buy a home, maybe they borrow money and they're going to go out and fix up their home. Maybe they need to fix up the home to sell it, or they're not on the market to buy a new home anymore. They're just going to go borrow money to fix up their home. Or if you want to go borrow money on your home at a 30, it's still really good interest rates, but if you can go out and borrow money on your home and pay off a car payment or credit card debt or your debts, you can leverage your equity in your house to increase your cash flow in your house. And you can, if someone wants just to do it just to help them, become more, have more cash in their household, or if they want to go qualify to go buy another house, you use the equity for this to go out and pay off some debt. It's going to, a lot of times it will make keep more money in your pocket, but it can also help increase your credit score. So, higher credit, which is a totally different subject, but credit is important. If you can increase your credit scores, you can increase your buying power. You can lower your interest rates. It helps you. We know a lot about credit, and a lot of time, if you go in and we kind of guide and direct you to what things to pay off. We've seen people increase their credit scores 60 to 100 points just by going off and paying off certain debts.
That's not credit repair. That's just you educating the consumer, your buyer, on what things that they need to do to raise that credit score. That's one of the big things that really made me want to partner with Eric Wommack is his knowledge of the credit industry, just the mortgage industry. Totally. We are going to come back and maybe talk more about credit and some things that you can do to help our buyers raise their credit score. So I would love to have that class. I know a lot of people will be interested in that class and what you can do to kind of help us. You said something. It brought this thought out is I think a lot of people now are going to that cash out option because we get those calls about, okay, Kirby, I know I can sell my house and make a lot of money, but where am I going to go? So I think now they're beginning to look at that cash out refi, saying, well, maybe if I take the money out of my house, I could fix the current house up, maybe to a level where we could stay here a little bit longer since they don't have anywhere else to go at this point. Is that kind of why you think you're seeing more cash out refis now than maybe in the past?
Absolutely. Or we're seeing it, pardon me, row 101, turn your phone off.
Yeah, that's okay.
Absolutely. We're seeing people fix up the home either to stay in the house or it's a term, it's called a bridge loan. Bridge loan is a type of a home equity loan. If you want to go buy your next house and you have a lot of equity or some equity or a lot of equity, but you need to tap into your equity right now to make your offer more competitive on your next home, we're doing home equities to give you the money to go be more competitive on the offer on your next house.
That's great.
So there's a lot of different reasons, and every borrower's got a different story of, but what we like to do is whenever we're consulting with the buyer, figure out what is your need. Are you just trying to lower your debts? Are you trying to, what is your goal? And we'll kind of help put together a plan of attack to meet the customer's goals.
Well, that's a great thing about working with a real mortgage professional that has a lot of experience. I'm sure Eric and his team, they've seen the market shift in so many different ways. So he can definitely help you and answer any questions that you have about your mortgage needs. We're going to stop here, and then I'm sure you'll see Eric again in the future. We're definitely going to have that credit class. And Eric, man, we really appreciate you stopping by today and taking time with us.
Appreciate it. Thank you for having me.
All right, thanks, Eric.